Focus. Ideate. Innovate. Enable.
Hello and welcome to another episode of NSE Fin Wiz, powered by CNBC TV 18 Season 3. Today we're shooting with the employees of one of Mumbai's leading 5-star hotels, Hyatt Regency, Mumbai.
Hyatt Regency Mumbai is the city's leading gateway hotel. A preferred choice for both business travelers and the city's discerning diners, the hotel is renowned for its exceptional hospitality services. NSE FinWiz visited the Hyatt Regency Hotel in Mumbai with the country's finest experts to advise and educate the young employees on investments and financial planning.
And we're now joined by our two very special experts. We have Nikhil Kothari, who's the director and the chief financial planner with Etika Wealth Management. Welcome to the show, Nikhil. And we have Kalpesh Ashar, who's the founder at Full Circle Financial Planners and Advisors. Welcome to the show, Kalpesh. And our core topic for today is debt instruments. So Kalpesh, we've seen the markets taking a bad beating, the stock markets, the equities taking a bad beating in this 2016 as it started. And that more and more gets people to say, I don't want to touch the markets, let me put more and more of my money in debt instruments. So is that a good idea? Should that be done? Should we put a lot of our money in debt instruments and just put all our money in debt instruments and forget about it?
Yeah, so that's a good question to begin with, Sumit, because it all boils down to the word called risk. And everybody has its own version of risk. So for some people, risk is probably to, get a better deal out of it, or probably for some people it's risk aversion. So today we are in the scenario where, we are looking at total bloodbath in the equity markets, and everyone is running helter-skelter and, literally taking cover. And they have a right reason for it, because the equity markets since the last 3 months have literally been in turmoil. So it's obvious that at least for the financially savvy investors who have probably not gone through good times in equity in the last 1 year or 2 years since they have started, so they would be having their views about, why did they come into the equity markets at the first place. But I think the question is much more broader here. So the question in what we are asking here is that, what are your goals for which you are investing? And that probably brings us to the answer that, is this the right time to get into debt instruments? So in financial planning parlance, we always say that, if you have your goals outlined, your asset allocation towards equity and towards debt automatically takes center stage. So if you have any goal which is probably below 3 years, we would never advise an investor to put his money in equity. So if the goal is beyond 3, 5, 7 and 10 years, obviously an equity exposure is required, because over a period of time, equity through the cycles which we've seen has outperformed. It's got a brilliant track record to it. So anybody who's entered equity in the last 2 or 3 years and has that much limited time horizon has literally burnt his hands. But if you have stretched your time horizon, then probably you would not be that worried. So debt instruments, obviously now people would be scared to get into equity, and that's where debt instruments now come into the picture. But again, when you're entering debt instruments, there's a whole, I would say a basket of debt instruments which have basically varying tenures, varying risk levels in debt also. So debt is not all about security. There is a certain amount of risk attached to debt also. So people need to take their own calls, plan out, and then take a call into debt.
Nikhil, Kalpesh spoke about goals and asset allocations, but we'll come to that later on in the show. There is one thumb rule, Nikhil, that I've heard, which says, 100 minus your age is the percentage of your savings, your investment that should be in equity.
That's right.
So basically, your age is the percentage that should be either in debt or debt and other like gold or other commodities kind of investments. So is that a good thing? Should we just stick to that thumb rule, or, it's really case-to-case basis?
No. So to a large extent, thumb rules are only derived to give you a ballpark number. But that doesn't mean that you just go and follow that, right? So what you always need to do that when you are investing, you need to know what is the purpose of investments. If you can't only say that I want to invest, there has to be some goal aligned to it. So first of all, whenever you start investing, first identify that why you're working, why you're saving this money for, and what is the purpose of this investment. If you say, if that is clear, that what is the purpose of that investment, based on that you decide that where I should invest. Like whenever you start traveling, right, so first you decide that where you want to reach. Right? You don't say that, okay, whether I should travel at 50 km per hour or 70 km per hour. The first thing what you decide is that where I need to reach, how fast I need to reach, and based on that I decide the speed which I want to go. Same thing applies in financial planning. That first identify your goals. If your goal is that I need this money for next 6 months, or I need this money after 1 year, then all the money should always be in debt. It doesn't matter whether you are 5-year-old guy, whether 10-year-old, or whether you're 60-year-old. So first is that what your goal is. If your goal is that I want this money after 30 years, right, then you need an investment class which will be able to beat inflation. Because when you're saving for 30 years, you should make sure that whatever return you get should be more than what inflation is. If your return is less than inflation, then your money is not growing. So you need to make sure that if your goal is for long term, you need to beat inflation. And then you need to select asset class which is able to beat inflation. So then you need to invest in equities.
Kalpesh, this question is from Biswajit. He says, what is the best debt instrument to put your savings in and earn consistent good returns on a long-term basis?
Okay, so there's a paradox here. So basically when you associate long-term with best returns, the answer is equity. Because if you are willing to park your money for a long term, obviously any track record which we've seen is that equity would deliver the best type of returns to you. But if your profile really does not allow you to invest in equities, then like we've explained the tax efficiency of a debt-based mutual fund, that even after 3 years, Nikhil again mentioned about 20% with indexation, it automatically nullifies, and as you progress year on year, it probably comes to a point where you are having no tax to pay. So, and the instruments in which they invest are of varying nature. So over a period of time, a good debt-based mutual fund would give you a very reasonable, I would say a head up against any form of conventional debt-based instrument. We also have the option of a tax-free bond. So if you're just looking for a tenure, which is long-term, and you want to be comforted with the fact that this is a regular income which I'm going to receive year on year, tax-free, sovereign guarantee, then the tax-free bond is the best option then.
On that note, it's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE Fin Wiz, powered by CNBC TV 18 Season 3. Today we're shooting with the employees of Hyatt Regency in Mumbai.
Is the term life insurance the best document to go for, or are these special documents which give you investment, they act as an investment document better? And is it sensible to go for these additional riders when you're buying a life insurance?
First of all, the life insurance, the only insurance you should buy is a term insurance. Okay, so when we take life insurance, the only the thing is that if something happens, unfortunate event in our life, our family should not suffer. So that's where the role of a life insurance comes in, and that's where term insurance comes in. Okay, so the only insurance you should buy is a term insurance. Okay, when we talk about riders, the riders are like we have base pizza and then we add toppings over it. So riders are just like a toppings in the pizza. Okay, so you have a base cover which is a term insurance, and then you add toppings and you add riders. So what is riders are basically there's one rider called as ADB, accident death benefit. So what it says that if I die natural death, I get the normal sum assured. But if I die through accident, then I get 1.5 times or 2 times the sum assured. So, and the riders comes at very, very cheap cost. So it's good to add those riders. There's another rider called as critical illness riders. So again, there are 2 types. One is called waiver and one is called as they'll give you lump sum money. So waiver is that basically if you're diagnosed with any other critical disease, you don't have to pay the premium any further and your policy continues as it is. Okay, and there's another rider called as if you're diagnosed with any other disease, they give you lump sum money. Okay, all these riders are very, very good. Why? Because first of all, when you're taking a term insurance and when you're young, the chance of dying a natural death is very, very low, but chance of dying through accident is very, very high. So if you take an ADB rider, it gives you double the sum assured and a very, very cheap cost. And the critical illness is very, very important because the lifestyle which you are living in, right, the whole junk foods and everything, the chance of diagnosing critical illness are very, very high. So with a small premium, the critical illness rider is a very, very good option. So go with term insurance with the riders, whatever is available to you. Now talking about investments and insurance, we should never combine an insurance and investment. That's the worst thing you can do. right? So when you're talking about insurance, only go with pure term insurance. When you're talking about investments, go with various investment options. So we have discussed about debt investment, we have discussed about PPF, we have discussed about equity mutual funds, we have discussed direct equity. So there are various investment options. Depending on your time horizon, depending on your risk appetite, depending on your goals, select the investment option. What are various options available to you?
Kalpesh, we've spoken about life insurance. Now, let's talk about medical insurance, Kalpesh. So that's also rather, how important is it? Does everybody need a medical insurance? And if yes, what's the right way to approach it?
Okay, that's, I think, a tremendous requirement in today's times, because probably, a living expense of an uninsured person through medical is really killing rather than death itself, So if a person who does not have adequate medical insurance, and God forbid if he is hospitalized, his family is in really troubled times. So very, very important that everybody is covered very adequately through health insurance, what we normally call as Mediclaim, but that's a product's name. It's called health insurance. And being employees, I'm sure many companies, I'm sure even your company would be offering you health insurance benefits. But a very sound advice would be that apart from that, please avail of that. Be covered medically also on an individual basis too. The reason for saying this is that, say for example, again, God forbid if there's a job loss and there is a certain transition period where you are trying to find out a new job, or there is something happening in between, you want to start a new enterprise, and during that period, if you are hospitalized, you are left with nothing. So don't just depend on a company insurance. Cover yourself and, more importantly, your family immediately. So health insurance is very, very necessary. Today, health insurance probably starts from as low as 2 lakh rupees or something, the cover. And with your age, if you're young, even the probability of the premiums being low is quite there. So 2 lakh onwards is what you could probably look at covering yourself. Create a contingency fund. Ultimately, you have to bear the expense at the time of a criticality. So please cover yourself, your family adequately. Look at what the company is charging you. More importantly, look at what features it is giving you. There are lots of clauses. There are pre-existing illnesses which are not covered for a certain time duration. So please go through that offer document, read it. Just don't sign blindly on the dotted line before taking your policy.
You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. It's time for a short break. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. Nikhil, let's talk about loans, both credit card loans and other loans. Now it's become really easy to get a loan, and you get a loan for almost everything under the sun. How does one decide what is the kind of loan that we should take, which is the kind of loan that we should stay far, far away from? What's your advice?
Okay, so loans are very easily available now, and so you get a personal loan in 10 seconds. So it's as simple as that, right? So, but again, when you're taking a loan, be very careful that what loan you should take and what loan you should not take it. Okay. The easiest loan is a credit card loan, right? You can keep on swiping your credit card, and you can only pay the minimum amount and keep on rolling over it, right? That's the worst loan you can ever get it. Okay, because the credit card loan costs you 36% per annum, right? So if you're not able to pay for 2.5 years, it's like double the money which you are paying, right? So the worst loan you can take is credit card loan. I'm not saying don't take credit card. Credit card is the best thing you should have it, one of the best thing, because it gives you convenience, right? But make sure that within a 45 days, whatever time frame is available, pay the full amount, not the minimum amount. Like there's a catch in minimum amount that you only pay the minimum amount, but from next month onwards, you're charged interest from the day you start spending. So don't get that 45 days period also. Make sure that you pay the credit card bills on time and don't use credit card as a loan. Okay. Then the second loan which is available is a personal loan. Okay. Now personal loan is advisable only when you need for any investments. Say for example, you want to starting your own company and you want to buy a vehicle which is very important for your business, and you are not getting loan from any other ways, then you can avail for personal loan. But otherwise, if you can avail loan from any other sources, again personal loan is very, very expensive, so don't go with personal loan. A loan which you should always take it is a home loan, because when you take a home loan, you get a tax benefit. So up to 2 lakh rupees, whatever interest you pay, you can take that as a tax exemption. So when you're buying a home, you can go with home loan because the rates are also very low. Today the home loan rate is 9.5%. So it's a very, very reasonable loan. And if you get a tax benefit, the effective cost is around 6.5 to 7%. So the loan which you should take it is a home loan. Don't go with any other loans. Now, a lot of times people need money. They can't escape it. So you have other available facilities. Like say for example, you get a loan against your LIC policies. You get loan against your fixed deposit. You get loan against gold. So you have various other sources where you can get loan. That loans are a little bit cheaper than your personal loan. So say for example, you need money, you don't have any other option, and you already have say LIC policy with that. So take a loan against your LIC policies and use that for your short-term goal and repay that again. So the advisable is that check out what are various loans available, what's the interest rate on all those loans, whichever is the cheapest loan, go for those loans.
What really would be the investment that I should be looking for from now, considering that I'll be able to start the investment only after 2 years from now?
If I'm asked you, how old are you?
I'm 30 now.
Okay, fair enough. So that suits my answer.
Yeah.
So I'll put a hypothetical figure and then you can take your call on it. Okay. Say for example, you need a corpus of 5 crore rupees.
Perfect. After 20 years.
Yeah, so I'm estimating it. I'm giving a hypothetical, you draw your own conclusions.
Yes.
So you want to retire at the age of 60. Okay. And you need a corpus of 5 crore. Probably many more would need. So if you start investing at the age of 25, an amount of 7,500 per month into any investment which yields you 12% per annum. I'm talking about a very conservative rate of return.
Okay.
12%. Now, I'm not naming what. It could be equity, if you're a real estate fan, real estate. But a 7,500 per month, ideally an SIP.
SIP, right.
You would reach in the next 35 years, 5 crore rupees.
Okay.
Okay?
Okay.
Say you delay this process by 10 years.
Right.
When you're 35, you decide that I want 5 crore rupees.
Right.
So you have next 25 years left.
Right.
At that time, you would require 26,000 rupees.
Oh.
Now comes the horror story.
Okay.
If you delay this by another 10 years, at the age of 45, and you've got only 15 years left,
Okay.
and you still require that 5 crore, you would require 1 lakh rupees per month.
Okay.
And the story is more horrible now, because at 45 you will have kids, their education, and the circle of life would have engulfed you.
Right.
Currently I have taken a loan, a home loan. There is a confusion about the tenure. Some people are saying it should be 30 years, some people are saying it should be 39 years. Currently I am 31. So if I think about my retirement and everything, what should I go for?
When you're deciding the home loan tenure, okay, first of all you need to decide how much you can save every month, and if you're taking a 30-year loan, the EMI will be slightly higher as compared to 39 years, right?
Yes.
So your EMI, so first of all you need to decide that whether I can afford the EMI even if I have to repay the loan in 30 years, or because I can't afford that EMI, so I have to longer the time frame and take 39 years, so my EMI comes down.
Yes.
So you need to decide that what exactly the EMI you can afford, okay, and based on that you can take a home loan.
Yes.
So even if you take for 39 years, it doesn't mean that you have to continue for 39 years. The best thing in home loan is that there's no prepayment penalty. Okay, so you can prepayment your home loan whenever you want it. Okay, so say for example you get a bonus in this year. Okay. Hopefully. So once you get a bonus, okay, you can use that bonus and prepay the home loan. Automatically you can either, then after that you can reset your home loan and your EMI, your tenure can come down or your EMI can come down. Right? So it's completely depend on you. So if you say that, okay, based on the EMI which I can afford, I need to take a 39-year home loan, take a 39-year home loan, but repay it as in when you get a lump sum money. Depending on your EMI, what you can afford, take a tenure.
Okay.
And whenever you have lump sum money, keep on paying it so that you keep on reducing your tenure accordingly.
On that note, thank you so much, Nikhil. Thank you so much, Kalpesh. Thank you so much for having us here.
I think this was a very good platform, especially for us hoteliers, because generally we are always want of time, running around morning to evening, and we do not have much time for finance and personal finance, if I can say that. So the simple queries which you answered was very informative, and I think it's an eye-opener, and I mean will really help us in going back home today and really having another look at what we are doing with the money which we earn and what to say.
I think the show was wonderful. It's an amazing platform that you guys have given us because, we do know about finance, but personal financial planning is something, that we have not gone into.
Well, that's all on this episode of NSE FinWiz, powered by CNBC TV 18 Season 3. But before we go, here's a chance for you to win a cool goodie bag by answering this viewer question.
The lowest interest rate is usually earned on a money market account, passbook account, certificate of deposit, mutual fund. Send in your answers at fwq@network18online.com.
We're coming close to the end of Season 3 of NSE FinWiz, powered by CNBC TV 18. So next week will be our final episode with the employees of Exide Industries in Kolkata. Do tune in. Until then, from the entire team, many thanks for watching.
Focus, ideate, innovate, enable.